Now, as the election is heating up, and now we're just about a little bit over a month to go until election day, what would a Biden presidency look like? And we're going to be doing even more videos covering the election as well as the economic standpoint from both candidates and both sides of the aisle. So what would happen to the stock market under a Biden presidency? What would be the initial results, and would it be good for the market? Would it be bad? Would it be positive? Would it be negative? We're going to look at just initially some early data and early information that we have, and then apply that to the market and see what would happen. But we're going to do even more videos, more in-depth covering when we get closer to the election. So if you don't miss any future videos and any future notifications, be sure that you are subscribed to the channel. Click that subscribe button and also click that little notification bell as well. That way you're notified every single time I make a new video. So one of Biden's promises is to reverse a lot of the Trump tax cuts from the Tax Cuts and Jobs Act that Trump had enacted. And Biden actually wants to raise corporate taxes and taxes on higher net worth and higher income individuals. And one of the fixtures of his campaign is going to be raising the capital gains tax. This could be detrimental to the market. And what is a capital gains tax? Well, it's essentially the tax that you pay on the profit earned from buying and selling a security. So let's take a look at how Investopedia defines it. So Investopedia defines the capital gains tax as a levy assessed on the positive difference between the sale price of the asset and its original purchase price. Long-term capital gains tax is a levy on the profits from the sale of assets held for more than a year. Now the rate's 0%, 15, or 20, depending on your tax bracket. That's what the rates are. And short-term capital gains tax applies to assets held for a year or less, and it's taxed as ordinary income. Now you can actually reduce the gains tax by deducting the capital losses that occur when a taxable asset is sold for less than the original purchase price, and the total of capital gains minus any capital losses is known as the net capital gains. You're not going to see many deductions though, because if you are holding for the long term and you are selling something after years or decades of holding it, hopefully you would not be at a net negative. This is all part of Biden's $4 trillion tax plan that he's calling for, and the capital gains tax increase is in there, as well as increasing the top tax rate for capital gains for the highest earners to 39.6% from 23.8%. That's the largest real increase in capital gains rates in history. Economic analysis show that capital gains tax hikes cause a burst of stock selling in advance of the increase, as investors look to lock in the lower existing tax rates before they rise. This should not be a surprise. So with so many investors, whether it's the average Joe Schmo or bigger financial institutions, you're going to be seeing a very large sell-off from the stock market, and that's just from the fact that there's a capital gains increase, let alone his tax increases on corporations and higher income earners. Now this was all studied and found and analyzed, and it's in a research paper by Tim Dowd. He's a senior economist at the U.S. Congress Joint Committee on Taxation, and Robert McClelland, a senior fellow at the Urban Brookings Tax Policy Center. They found that the two previous hikes in capital gains taxes led to a wave of selling. So there would be a initial, maybe not long-lived, but at least in the short term, a large sell-off in the stock market on top of this pandemic. Now, although overall Reagan did lower taxes, and speaking of Reagan, we do have the It Can Be Done replica here that I showed you in my previous studio video, where I showed you my brand new $2,000 studio. If you're brand new here, go ahead and hit that subscribe button if you are brand new. But as part of the Reagan tax plan in 1986, the top rate for capital gains jumped from 20% in 1986 to 28% in 1987. And in the months before the increase, capital gains realizations, or sales of stocks and other assets, surged by 60%. In 2012, as part of the fiscal cliff negotiations, the top rate went from 15% to 23.8%, and then again, it was evident because in the months leading before the change, capital gains realizations and sales jumped by 40%. So in other words, under those Obama-era increases in the capital gains tax, we did see initially a large sell-off, although under the totality of the Obama presidency, the market did perform exceptionally well. It was very straightforward, very simplistic, nothing too convoluted, investors, people that are in retirement or larger financial institutions, they want to make the most out of their investments, and so they don't want to wait for those tax increases. They want to try to sell their stocks or securities, whatever they're holding, as soon as possible. That way they're not impacted. According to the analysis, the short-run effect involves taxpayers rebalancing the timing of their planned sales to correspond to the timing of the tax rates. And then I wanted to say that the spikes also include realizations that occur to take advantage of what has become a temporarily low tax rate. And interestingly enough, if you look at the relationship here, the analysis showed that every 10% gain in the capital gains tax rate, so under Biden you would see that, a 7% change in capital gains realizations occurred. So 10%, 7% for every 10% of increase of capital gains. So under the Biden plan, his plan calls for a 66% increase. That doesn't mean 66% as the tax, but rather a 66% increase in the capital gains rate. So that would more than enough lead to a 10% gain and then that 7% change in capital gains realizations. So in this case, it would actually be a more than a 6 times effect here. So with that being said, this could lead to what they're saying, a 45% to 50% increase in capital gain sales. So in other words, it could create a large downward force in the market, and we don't need another one of these. After coming off the pandemic, and now in recent days and weeks, we've seen an insane, precipitous sell-off. The market is hemorrhaging, particularly the tech sector. Apple today, as I'm filming this, just slid another 4%. Breaking news. Now it is worth noting that the capital gains tax increase does not necessarily mean in its entirety as a whole that the entire market is going to turn into a bear market and into a recession, but initially you do see that sell-off. For example, if we take a look at 1986, we did see the market continue to rise exponentially even though there was that tax increase. Now when it came to late 2012, early 2013, the markets did have a more bumpy ride, but this was due in part to a broader government dysfunction and the threat of a government shutdown. So economists do say that there would be an increase in stock sales if Biden does lead to victory. However, we would actually see an offset from other factors under his presidency. Biden's tax increase would only apply to taxpayers earning more than $1 million, so the pool of sellers could be smaller than the investors affected in 1986 and 2012. So the share of the stock market owned by individual investors or those who are subject to the tax has also declined over time, reducing the impact of a tax hike. Research by Stephen M. Rosenthal, a senior fellow at the Urban Brookings Tax Policy Center, and Lydia S. Austin, a research assistant at the center, found that the share of all corporate stocks owned by taxable individual investors has fallen from 84% in the 1960s to just 24% as of 2015. And that means that 3/4 of the stock market is owned by institutions, pension funds, retirement accounts, foreign investors, and pass-throughs that would not be subject to a capital gains tax. And only a portion of the 24%, those with incomes over $1 million, would be affected by the Biden tax, so the effects would for the most part be diluted. And of paramount importance, market experts and economists say that over time the overall direction of the market tends to be driven by more broader factors other than just something like that tax rate increase. For example, interest rates, economic growth, corporate earnings, that is more of paramount importance than just a single tax policy. And with interest rates so low, there are a few other places for investors to put their cash if they sell. So some market experts say investors could sell their stocks to capture the lower rate and then jump right back into the market, limiting any market decline in the near, short, medium term. According to Roger Altman, he's a founder and senior chairman of Evercore and a Biden supporter, he said that, quote, an increase in the capital gains rate would always lead to sales of equities and securities prior to the effective day of the increase, and that will happen every time, but the long-term effects are not historically negative, and those long-term effects depend on broad macroeconomic factors, not just the capital gains rate. So in layman terms, you would see that initial sell-off, you would see that initial decline, but for the long term, for the most part, if the government does run smoothly, if the economy does continue to grow, and due to broader factors other than just that small increase, overall the market should perform maybe not just as good under a Trump presidency, sans the pandemic, but perhaps maybe even better according to some economists, but it should do almost just as well. You would absolutely see an increase in taxes. You would see those tax increases when it comes to corporations and higher earners and higher net worth individuals. However, this could be offset by other factors due to the fact that it's not going to affect the average Joe. No pun intended. And no matter which party or person is in office, no matter who the incumbent is, we always do want to stick to that strategy of holding long term. We're not going for the short term here. It's all about the bigger picture and the broader scale. So even if the worst president in history for the economy were to step into office, you'd still want to hold on. It does not mean that you should sell your stock. I'm curious if you would prefer for the economy a Biden presidency or a Trump presidency. Let me know down below in the comments. Maybe we'll even do a poll in the community on YouTube here. We'll do that in the community section leading up to the election. But who would you prefer for the economy, Biden or Trump? Not necessarily a question of who would you vote for, who do you prefer, but rather who would you rather for the economy. We'll be sure to do more videos covering the election and what would a Biden presidency look like, or would a Trump presidency continue to be better for the economy. We'll do more videos monetarily speaking, economically speaking, as it does get closer to the election. But I hope you enjoyed this video. If you got value out of it, go ahead and give the video a big thumbs up. Smash the like button, just help with that YouTube algorithm. YouTube will push the video out to even more people, get more eyeballs in the video. So I do appreciate when you do that. It does support me so I can continue to do daily uploads for you guys. And if you want to see more videos from my channel, go ahead and hit that subscribe button, because I post videos every single day now covering business, finance, investing, entrepreneurship, mindset, strategy, and tips and tricks from my own experience. So if you're interested in any of those topics, go ahead and click that big red button, hit the subscribe button. And if you want to be notified every single time I make a new video, click that notification bell as well. That way you're notified every single time I do upload a new one. Looking forward to seeing you in the next video.